All right, this is problem 3.12 from chapter 3 problems in the CFA textbook, Corporate Finance, A Practical Approach. This is a long and convoluted problem. All right, so best to break this thing down into pieces and talk about what you're going to have to do. The cut to the chase. If Trumpet, the last sentence says, if Trumpet raises $7.5 million of new capital while maintaining the same debt to equity ratio, its weighted average cost of capital will be closest to. Okay, so we need to know the current debt to equity ratio, which means I need to know the market value of debt and I need to know the market value of equity for Trumpet. All right, so that'll give me the debt to equity ratio, and then I can go in there and calculate the stuff for the new, for the rest of the problem, because they're telling me all kinds of stuff in here. Enough stuff that I can calculate weighted average cost of capital. All right, but I need to know that how much new capital they're going to raise, how much capital they currently have. All right, so current and then additional, and then the new cap structure. All right, so if I know how much they currently have, piece of cake, I can use the additional. They're going to have an additional $7.5 million total. So my total capital for the new structure is going to be $7.5 million. All right, that's given in the problem. Okay, I'm going to raise $7.5 million in new capital, and it's going to be in some mix of debt and equity, so I need to go out there and figure out what that mix is now. All right, well, currently the market value of debt, I can calculate that given the problem. They say they have $10 million face value of bonds that have 5 years remaining to maturity, 8% coupon and semi-annual payments. Price to yield, that means the yield to maturity is 13.65%. All right, so number of periods, rate, PV, FV, payment. I can calculate the market value of their existing bonds. They have 5 years to go, but they make 2 payments a year, so that'll be 10 payments every year. The par value is given at face value, par value, same thing, is given at $10 million, and the coupon rate is 8% of the face value, but they make 2 payments a year, so that's $400,000 a year. And the yield to maturity is 13.65% per year. Well, half of that is what the semi-annual rate is. So I can get the market value, number of periods, payment, and so the market value of their debt is currently right at $8 million. Okay, so that's the market value of the debt. Let me pretty all this crap up so it doesn't look near as ugly. I'll just make it currency and 0. All right. I said I'd make it currency and no decimal places. All right. So I need to know the market value of the equity. Well, I got a hint in here. They said they can issue new common shares at $10 a share. That's the current market value per share. So that $10 a share, and they have $1.2 million common shares. So that's their market value of the equity. They currently have right at $20 million of capital. And the debt to equity ratio, the debt as a proportion of equity is about 0.66666, whatever, okay? To be able to figure out of the $7.5 million that they need to raise, well, the debt to equity is one way of doing that. I can also say debt is right at about 40% of the total. So they're going to have to add that much additional debt so the new stuff will come in at about roughly $3 million of debt, $4.5 million of equity. I'll just go ahead and leave this crap the same because I'm not bothering around. If I bothered around, we might get cleaner numbers, but it's a spreadsheet and I don't care. So the new capital structure, they're going to add $4.5 million of equity to the existing $12 million of equity. They're going to add $3 million roughly to the existing $8 million. Okay, so grand total of $27.5 million. Notice that the debt to equity ratio will stay identical throughout all this. Okay. So if I want the weights of debt and equity, all right, so debt is 40%, equity is 60%. All right, now I'll make this look a little bit prettier. And so if they keep the same debt to equity ratio, then the weights of debt and equity are going to stay the same. When they raise the $7.5 million in new capital, it's going to be roughly $3 million of debt, $4.5 million of equity. Okay, so if Trumpet raises that while maintaining its weighted average cost of capital will be closest to, all right, the expected yield on the entire issue. If they go beyond $2.5 million, the cost of debt will start. The pre-tax cost of debt will be 16%. All right, so pre-tax K of debt, 16%. The tax rate given in the problem is 30%. So the after-tax cost of debt would be the pre-tax cost times 1 minus the tax rate, 11.2%. All right, so that's, I'll need that number again. The cost of equity, I can use the capital asset pricing model. The CAPM is the risk-free rate plus market risk premium times the beta. Okay, so given in the problem, the stock has a beta of 2.2. All right. If we go down here and then look, the expected market return is 10%, risk-free rate's 3. So what that's telling me is that the market risk premium is 10% minus the risk-free rate of 3%, and the risk-free rate is 3%. All right, and the two of those add together to added together give you the total rate of return. All right, so the market risk premium is 7%, and that means that the market total return is 10%. The risk premium for this company is that times its beta. It has the same risk-free rate, so the cost of equity for Trumpet is 18.4%. All right, so weighted average cost of capital is equal to the weight debt times cost of debt plus weight of equity times cost of equity. So the weighted average cost of capital would be equal to, the weight of debt is basically 40%, 0.4 times 11.2% plus 0.6, the weight of equity times 18.4%. All right, so go in here, just use the cells from a spreadsheet. 40% of that times the after-tax cost of debt plus 60% of that times cost of equity. And I hate Excel going bananas with that decimal place thing, but it's what it does. And of my choices, the closest one is B, 15.5%. Okay, so long convoluted way of calculating cost of capital, that's a good test question.